In today's class, I'm going to discuss how to use range bar charting to improve your trading. Range bars are different than time bars in that they are based on a certain number of pips per bar and then a new bar starts. So in other words, if you set up a 6 pips per bar chart, when the market moves 6 pips, it can start off, go up 6 pips, then there's a new bar, or it could go up 3 pips, back down to where it started, and down 3 pips, and then a new bar starts. If there's any economic news during a bar, it shows that gap in price on the same bar. There's no blank space on the charts. Many traders ask me, how many pips per bar should I use? What I like to do is find a time-based chart that I like. For instance, I prefer 5-minute charts for intraday trading. Then I will just simply pick the currency I want to see the past stats on, and right-click on the chart, and you go to ATR, and then you just simply click Add Script, click on Median, Add Script again, and then you'll have what I have on the bottom. You can also adjust the start and end times if you want to see the statistics for different times of the day. If you only trade from 8 to 11 each day, that's the times you only trade. You don't trade anything other than that. You might want to see what the volatility is during those times on average and use a range chart that reflects that. And so this is the average from that whole time, 4.93. If you scroll back, you can see it for any particular time. During the more volatile times, it can be 8.21, and the median on the bottom is 7.2. You can take both of these numbers and average them together, or you could just use this as a starting guide point and then take a look at a bunch of them that are around 4. You might look at a 4 pips per bar chart. I think that's too fast. You might look at 5, 6, or 7. This is just a general rule of thumb to let you know, to approximate a 5-minute bar, this is how many pips you would put on there. Now, when the market's active, you'll have a ton of bars, and when the market's just kind of going sideways, you'll have fewer bars. So the advantages of a range chart is you can usually see much farther back in price history than you can with a 5-minute bar. Because look at all this multiple hours here where there's nothing going on. So let me bring up a Euro-dollar chart, EUR USD, and let's say we'll use a 5R chart. R stands for range. If you wanted 7 pips per bar, you would put 7R there. And you don't need 6 days back. It's going to have to download tick data to create this. And then you click OK. And while that's loading, let me bring up the hot list over here. This shows all the major pairs, all the major currencies right here that we trade, and it shows you something very similar to this. It uses a slightly different formula to conserve resources because people have it up for more currencies and more time frames. But this shows you what a 2-minute bar does, 5-minute, 15, 30, and 60. And it can also be used to, let's say you're trading the Euro-dollar. The Euro-dollar moves about 19.9 pips per hour. So if you get into a trade and you think it's going to last an hour, 20 pip profit target makes sense. It's going to take about an hour to move 20 pips. Now, this is the average, so if the momentum is very strong like it was today, you might shoot for 1.5 times that, so 30 pip profit target. If you only have an hour to trade, you might, or let's say you want to leave for lunch, you have your stop in, you might set a take profit level 25, 30 pips up, for instance. But anyway, the Euro-dollar, it shows 5.2 pips. Now, here is the 5 pips per bar chart, and notice again, during that dead time, all the way from 7 to here, if you put this chart the same width, you can see more of the chart. This goes back to 1800. Right here. Notice this whole sideways range right here is reflected in, maybe 2/3 fewer bars. And I think personally that the range chart is just a lot more intuitive. You have a little bit of choppiness up and down here. You can draw trend lines off of the bar's highs in a superior way. In fact, one of the main ways that I trade, if I don't feel my best, is just basically look for pullbacks with trend lines and get in, and when the market stops going up, I get out. I use a currency meter always to find the ones that are most likely to trade. And of course, you can use this, and you can also eyeball it and use that to get out. 33.95 you're out. This last trade you're in at 75, you made 20 pips on that one. And in some cases, you can see Fibonacci areas more in a superior way than you can on regular charts. You don't have as many huge wicks, and it's just cleaner. And you also see patterns like this where you get a pullback, and it was where the previous low was. Once it goes up and down, and you get two lows confirmed right here. When it breaks out over the high right here, it's a pretty high probability trade. You might have been in here with your stop underneath the low. It didn't stop you out. Then it went up to the fib target. You made 25 pips on that trade, for instance. Now, if you wanted to look at a little bit longer time frame trading, let's say you prefer the 15-minute bar. For the euro dollar, that would be about 9.2. You hit 9R, hit enter, and now you can see 9 pips per bar. And again, very nice, beautiful sideways action like this. If you're in this trade and it goes sideways, typically you want to put your stop underneath the low. You might have got stopped out here and had to get back in. You can yank your stop up, yank your stop up. And usually trends don't move more than 3 waves. So this is the first wave. I'd call that the second wave, and more than likely this one is the third wave. And so I would be out of this trade. Most of the time on the third wave, it doesn't go past the 1.618 fib target. So excellent place to get out of that trade, and really at that point start looking for counter trend trades. Usually it'll at the very minimum pull back 38% after moving 3 waves. So you have a 3,400 profit target, which is a tremendous number of pips away. Even if it only comes down half that much, you make 4 or 5 times more than what your small 6 to 10 pips per risk is, where you put your stop loss. So that's how you set up the range chart. Let's look at some range chart examples. There's certain patterns that you will find in a range chart. Now, if you use the currency meter to find the strongest ones, the euro was one of the strongest ones today, and the yen was one of the weakest. See this? So the euro yen makes sense to trade. So you look at and I like the 5-minute bar. If you find the euro yen right here, 4.2 pips per bar using this. If we bring it up on the chart, just to kind of see what these are, this lets you see the median and the average. So you can see it's kind of right around there. I personally don't like to use less than 5 pips per bar, but we'll, in this example, put euro yen on here, and we'll go to a 4 pips per bar chart. If you don't like the way it looks, then just simply hit 5R. First we'll start with a 4 pips per bar. And you can see it really kind of gives you, in my opinion, a much cleaner feel for what's going on than a 5-minute. Here's midnight. Look at all this distance right here, just chopping around. Multiple hours of sideways range. And on this chart, it takes up less space. There's fewer bars. This is a beautiful little pullback right here. And there's multiple different methods you use with a range chart. It makes wonderful rectangle sideways pattern breakouts very visible. And also, if you have the bars timed properly, usually when you get a 3 to 5 bar pullback, the first bar that goes green, in an uptrend, you can buy it when it goes 1 pip above there. So again, that's one of the reasons why I don't like it 4 pips per bar, because I use that method frequently. So if there's 5 pips per bar, it's going to mean there's at least at the very minimum a 15 pip pullback before I get in. And so it really frees you from having to look at the chart, look at the prices, and figure out what the trends are. Now you can see this thing's, actually this is not live, I thought it was, but we'll go to a 5 pips per bar here. And if you want to really find even more high probability trades, you might find fewer trades, but they're more likely to be winners, go to a 6 pips per bar. Now you need an 18 pip pullback before you can start looking for buys. So you can see this was going up. You got 1, 2, 3 bars right here. 1 green bar, you buy it when it goes 1 pip above there. Now typically I will put my stop underneath here. If it goes up and can't get above the high, I tend to watch our FX build a trend tool to see what the momentum is. If it's not that high, I get out of half at the double top, small profit, maybe 10 or 12 pips in this case, and then I move my stop up to break even. In this case, we had a small profit, break even, had to re-enter, and you can see it took off again. Beautiful, nice little rectangle pattern right here, kind of like a wedge as well. And most of the time, when the market does take off, it's going to go to the first or second Fib target. And this one didn't quite get up there, which means I might not have bought this next pullback here. But when it came back up again and failed to go lower, I would have taken this trade right here, and then it took off. And again, beautiful, using a proper number of pips per bar. When you get a pullback of 3 bars to 5 bars in a row, 1 green bar, you go long. And it's beautiful because you can see fib areas on here that you might not be able to even see on a regular 5-minute chart. If it goes up and kind of goes sideways, I tend to exit half, and I probably would have been out of this trade here, and I wouldn't have re-entered because this would have been my likely profit target. Let's look at some other ones that were strong and weak today. Strong euro. The CAD was weak. The euro CAD is not one that many of us trade. I don't have that in my other thing, but we can look at that on here. See what the normal volatility is. And it's pretty low, so it doesn't typically, most days, move that much from 3 to noon. Again, I don't like to use anything less than 5 pips per bar, but you could put a euro CAD on here, and we'll just leave it at 6 pips per bar that we have already set. When you have a strong move, and in this case you have the multi-bar pullback right here, you wait for 1 green bar and you get in with your stop, usually a pip or 2 underneath here. And so in this case I would have lost a little bit less than 10 pips, but it failed to really go lower. So when it breaks out again here, I'm in again, and then you can see on the chart it just absolutely takes off. Losses are a part of the game. Sometimes you're going to get a loss and you have to re-enter, sometimes 5 minutes later, 10 minutes, sometimes even a minute or two later. In this case, maybe a little over an hour later, and it just goes up and goes sideways. You can a lot of times yank your stop up underneath. Every time it goes sideways like that, you yank your stop up underneath here. And usually, like I said before, 3 waves. This is the first one, second one. I wouldn't really expect it to move too much more than the second wave. So if I was in this trade, I would have probably exited the entire trade somewhere up here at 34.30. It did go up another 30 or 35 pips. But most of the time that doesn't happen. If you wanted to take a trade like that, you can always, kind of buy this pullback right here. There's a little flag pattern. When it goes up and makes a higher high and goes sideways, move your stop down. You would have had a very small profit in that case. Again, most of the time when it has already made 3 big moves, it's not going to go that much higher. So you can draw your fibs a little smaller. And if you do, or if you hold on or keep getting back into these trades, use that and exit the entire trade. The more up it goes, the more likely I am to use the 1.382 fib target to get out of the whole trade. If it's just starting a trend, I will tend to use the 1.618 more often. Let's look for one more example. Today the pound was strong, however the weekly and monthly trend's down, but the yen was the weakest one. So let's take a look at the pound yen. This one again is less volatile lately than it has been in the past. Again, I like 5 or 6 pips per bar chart. Put the pound yen on here. It has to download all the tick data to calculate the number of pips per bar. And you can just see, beautiful entries on here. Here it was a 3-bar pullback, green. You might have went long right here and had a small loss, and you got back in this trade right here. And a lot of times they don't go immediately your way, depending on how strong the momentum was. In this case, because the pound's weekly and monthly trend were down, when this kind of went up like this, I would have yanked my stop to break even. I would have got out of there with maybe a 4 or 5 pip loss. I would have had to re-enter here, and then you can see, you draw your fibs on that last wave, because the weekly trend was down, you're watching the real-time momentum, which I don't have on this chart. I didn't leave this one running overnight. But you can see this is an excellent place to at least at the very minimum, get out of half of your trade. You know, it's almost a 50 pip move. So it doesn't take a whole lot of nice sized moves to get back. You know, you can have 2, 3, sometimes 5 losses in a row. I mean, I almost never have 5 losses. 2 is usually my max. I'm very careful about the third trade I take. Try to find trades that are rare and happen seldom, but are 70 or 80, 90% likely to work. And I trade, you know, much bigger lots on those trades to get back the losses if I do have 2 in a row. But that's a whole separate class. But you can just see strong trends, nice patterns. And let's just, for illustrative purposes, show the pound-yen 5-minute chart. Yeah, look at how much space it just went sideways right here for almost 3.5, 4 hours. Whereas on this chart, it did the same thing, but there was much fewer bars. And you might say, I want to wait for the trend line to get broken right here. You might have been in that trade right here a little bit early. Sometimes once they go sideways for a couple hours, you can usually spot breakouts. A lot of traders wait for the breakout to be all the way up here at 39. You get in this trade at 30, you have 9 pips more potential profit if the trade works. And because you put your stop underneath the swing low, you're risking 9 less pips, which means you can trade more lots. So when the trades work, you have bigger profits. Now, the pound yen, when this thing goes up, you can always, when it goes sideways like that and comes down underneath the lows, exit half. When it breaks out again, you get back in it again, and you have this swing from here to here. I'm going to exit at the first or second one. If it shoots through the first, I'm in. If it shoots through the second, any sign of a red bar, I'm usually out of that trade, or I will put my stop 1 pip underneath there. So I'd be out of this at 128.02. Because again, rarely do markets go above the 1.618. And if they do, usually they're going to pull back more. You know, the trailing stop on this would probably have been somewhere right here. So I'd rather get out at 02 or 03 than 97, 98 and make another 4 or 5 pips profit. Again, a lot of our losses are only 5 to 7 pips. Once you get into a trade, starts going your way a little bit, your trailing stop yanks up, gets cut in half oftentimes, and so you have 5, 6, 7 pip losses. And so if you can catch another 5 pips on one of these trades, you can eliminate one of your tiny losses from an earlier trade, you know, and that's why I do it.